right, we are live with another edition of the Sunday Scaries Stock Talk podcast with special guest Paul Cerro at Paul Cerro, both on Twitter and Common Stock, if I'm not mistaken.
Yep. Yeah, this is my name.
Yep. So, Paul, thanks for coming out. How you doing today?
Yeah, no, thank you. I'm doing good. It's a Monday, but hopefully the rest of the week goes by pretty quickly.
Yeah, so we're recording this on Monday, April 4th. We'll release it a little later in the week, but Paul, tell me a little bit about yourself. I know we kind of linked up through Common Stock. So for those of you that are listening, Common Stock is more so, I guess, just like a financial Twitter, FinTwit platform. Allows you to, divulge some of your holdings if you'd like and write some longer form breakdowns of like stocks and investments and things like that. So it's a great platform if you're looking for just like financial data and things like that, people's breakdowns and all that kind of stuff. So, Paul, how did you find Common Stock and how did they find you? And I guess get into your whole investing journey and background and everything like that.
Yeah, I mean, to kind of answer a few of your questions. So, I mean, I started off my career in investment banking, actually. So, I was an investment banker at Merrill Lynch. 2018 is when I started in the consumer goods and retail group. So basically covering all the companies that you, me, and every other consumer can either walk into a store and like physically buy or like order from online. That's basically what our coverage was. And then that was also the year that the cannabis industry was like going live, right? That's when like Tilray and everybody else like went public, the New York Stock Exchange, et cetera. So that was also my area of focus as well. And then fast forward, I'm still doing actually. I had a couple things. So I transitioned from a traditional finance role over to doing strategy for a healthcare tech company, in which I'm also currently doing that again. So like my main job is doing strategy for one of those DTC startups, or actually in this case it's B2B. And then on the side, which is the Cedar Grove Capital, I actually manage like friends and family's money via a long short capacity, specifically geared again towards the consumer and retail with like a little bit of tech, since like nowadays it's kind of hard to not be having some type of tech enabled aspect of your business, and then also the cannabis side as well. But like, to be honest with you, I never really used Twitter. I got a Twitter like in 2014. So you actually go to my profile, since I've been on for like almost a decade now, but I never used it. I just created it and I was like, all right, this is dumb. And then, like once I started to kind of want to advertise myself, right? And like what I was doing, I took to Twitter and noticed that like some people were like sharing like thoughtful advice and like opinions. And like, I got to like, see what other people were thinking. And from there, just from me posting things and interacting with people, I was able to meet some of the team members of Common Stock, and then they reached out to me like, "Hey, like, I see that you have your own like Substack that you're writing for, and that you're pretty active, and just in general. Like, did you actually want to talk about Common Stock, which is a cool thing? Blah blah blah." Hopped on a call. It's like, okay, it doesn't hurt me to have it, right? So I joined, and then from there, it's like you mentioned before, it's kind of like a FinTwit thing, but with like different kind of aspects. So it's nice to have exposure to both. But that's kind of how at least career-wise, how I started and what I'm doing, and then also like how I interact with Twitter, and then how I got introduced to Common Stock.
Awesome. Yeah. So, I'm all kind of along the same lines with you on Twitter. I've had mine for quite a long time, but now you see my dog is
it's okay.
but I had mine for quite a long time as well, and I kind of just used it to follow more sports stuff, maybe a little bit of news, things like that. And then within the past couple of years, as I got more into investing, I just kind of, I don't know, I just found things. And Twitter's a weird thing where there's a lot of different, I guess, sectors and areas of people that you otherwise not really notice or find that they're just all kind of into the same thing. So I mean, whether it's investing, or even I got into the weeds of like baseball card trading cards of Twitter. So I mean, like, like I was like you were saying, there's a bunch of different things and different aspects, and yeah, common stock's a great platform, and that was kind of the same way that they found me as well, as through Twitter and my Substack and everything like that. Um, so yeah, so it sounds like you've been investing for, about since 2018, or that's when your career started. Did you do any, like, I guess, personal investing prior to that, like maybe when you were going through school or anything like that, or did you just kind of start when you were, first getting your start into investment banking?
Oh yeah, no, I mean been I've been introduced to the stock market ever since '07. Because like that was like my dad was a very active investor in his own right. He was a finance person, but that's how I got introduced. Like when you saw like, oh my god, the world's collapsing. Why is the world collapsing? Like the whole economy is falling apart. So I got introduced, I guess, when I was like reading like the New York Times in the mornings, and you'd see like the Dow dropped 777 points, and you're like, I don't know what this means, but it doesn't look good. So like, it just got from there and there. I got so interested because like from a young age, like my father kind of ingrained and my sister and I like, hey, if you like take $1 that you earn and you can like invest it, it can become like $2 later on. And I'm like, by doing nothing? And he's like, yeah. I'm like, oh my god, like, I was like so like crazy about this concept. And so I've been knowledgeable since then. I invested in college because like my university had an investment fund. And so it was actually a student run investment fund that was quote unquote value focused. We kind of stretched the truth of that, to be honest with you. Because again, you're in college, right? Like value can mean many things. But then when you get to Wall Street, though, you're kind of, I wouldn't say forbidden. It's just that it's next to impossible to trade or invest on your own accounts because like you have like so much like material non-public information like MNPI, so that you could in theory be like insider trading like basically every minute of the day. So they don't want you doing that, so they kind of like, hey, if you have accounts, close them. The only thing you're allowed to invest in are like ETFs, right? Because they're so diversified that you can't really manipulate anything because of that. Or you just pay an outside financial advisor to do it for you. I didn't really care at that point, so I was like, you know what, just put it in my 401k. Let us do its thing. Vanguard will do it for me. But then ever since I was able to like when I left investment banking, that's when like my whole like I wasn't there's no restrictions anymore, right? There's no more red tape. So I'm like, great. I waited my 90-day grace period after I left, and I was like, all right, cool, fund the account, let's go. That's exactly what happened.
Well, yeah, there you go. That's awesome. So, I mean, that's pretty interesting that you started getting into it with, right in 2007, and of course, the impending 2008 crash. Do you kind of think like you first learning about investing in all that during that time? Does that kind of shape your mindset now and kind of I guess help you ride some of the waves at least early on, and I guess shape your mindset as far as like dips and volatility goes?
Yeah, I mean, the thing is, like, you're constantly learning, right? And everybody who says, and if there's anybody, even like the old timers, right? Like the guys who have been investing for like 25, 30 plus years, are like, they they don't know everything, right? Because like those are the same guys who are like in the 90s, who are like, Amazon's a bubble, and you know what, it's never going to be anything. And then now you fast forward another 20 years, and you're like, that was probably the dumbest thing you could have admitted, right? So yeah, I'm always constantly learning things. Like while investment banking definitely closed the gap of a learning curve very, very quickly. Like 2020 was definitely a learning experience for many reasons. 2021 also, just so many things were happening. But no, I'm always learning. The best thing, the one leg up I think I would say I have, which is kind of why like, some people have given me their money, is that like consumer retail is great because of the fact that like it's so relatable to us, right? Like I can go into CVS. CVS is a publicly traded company. I can see how it's doing. I can go buy like toothpaste, P&G, right? Like that's the people who sell toothpaste. Gyms, pet companies, lawn care, like anything. I can the level of due diligence that I can do. Not that I have a leg up in due diligence, but just saying like I can do so well with it because I can just go and do it myself, right? I'm not going to be able to go to a Twitter and be like, "Hey, how's Twitter doing?" Like, no, I can only look at what it gives me. So with each kind of like passing of time, you kind of you hone in on your skills and you understand better about like why things work the way they worked or why didn't things work the way they didn't work. Like how wrong were you, how right were you, and like what were the reasons for each. And for me, it's just so much easier with the industry that I cover or the focus that I cover. Um, mainly because of it, it's so intuitive, right? Like you can teach it to anybody. And which is still surprising to me how a lot of people can still get it wrong, even though it's pretty intuitive. But yeah, no, it's always a learning experience, and like that's kind of like why I've settled on those particular industries and why I plan on sticking to them.
Nice. So, I guess that brings you to my next question. So it seems like you kind of look at companies based on consumer goods, maybe what you would buy or where you walk around and you observe. How do you find specific companies that you like to invest in, and how do you go about analyzing them?
Yeah, so good question. One of them, I have a lot of books. Well, that's only some of them, but the rest are in my room. So Peter Lynch, I know it's talked about, investor, Magellan Fund, back in the was it 70s and 80s. Uh, I resonated with him so well in one of his books, One Up on Wall Street, which I highly recommend to anybody ever who wants to learn about investing. And his whole premise was basically like taking down an idea into its core simple root and then being able to see like, oh hey, does this make sense, does this not make sense, and like why. So with a lot of the examples that he gave, I mean, granted they were back in the 70s and 80s, so things were a lot different than they were now, but he would be going to like a motel inn and stay at a motel inn and like see firsthand like this place is killing it, like let's go. He would be buying into like toy companies and stuff like that because like his kids would ask him for toys and he's like these things are so hard to get because they're so high in demand, but like the stock's not moving, like what's going on, and then he would invest. So it's stuff like that kind of helped. And sorry, I was kind of on a tangent. What was the actually original question? I forgot. Sorry.
No, it was just yeah. How do you go about finding companies?
Oh, right. Yeah.
Yeah.
Sorry. Yeah. So the thing is, like, because it interacts in my daily life, like, so I have a dog, right? One of the, in a different aspect, like last year, I invested in the pet space, right? In the beginning, I actually ended up going long. I still am. I went long PetCo. They just went public in February of last year. Maybe it was January. I forget. Anyway, they went public. I was shopping at Petco. I was buying things for my dog from there, and like being able to see it firsthand. But then also I made this short call for Chewy saying like I also bought things at Chewy, and like Chewy's a great company, but I think it's not worth that. I think it's not worth that much. So because I was able to kind of have the exposure to my dog, I got introduced to the pet industry, and I was able to see it firsthand. Because a lot of the ideas that I come up with are thematic in nature, so they have like themes. The pet space being one of them. I've invested in the fitness space, right? Because like in a post-COVID world, I mean, I don't know about you, but I needed to get out of my apartment. I needed to work out, like not in my apartment anymore. Other spaces like vertical farming, like that's one that like many people don't really know about, but it's like going to be so big and also important for the future. It's inevitable at this point. So a lot of the investments that we do have some type of theme behind it, and then whether that's on the long side or the short side, um, uh, there isn't a reason why they wouldn't fit into like one of those buckets, right? So it kind of starts with a theme, and then from there it's like, all right, well, based on that theme, who's doing well or who's doing not that well, why? What's the potential here? Like, is there a clear runway? Like, do they have white space potential in like domestic or international markets that they're not really exploiting right now? Can they monetize consumers more than they currently have, or more than like analysts or investors currently think they can. Like it's stuff like that. But from top down approach, it always starts with the theme, and then it goes more and more granular to all right, who's killing it, who's not.
All right, awesome. So yeah, so a few things in there. So yeah, you seem like you kind of, I guess, split companies into buckets based on, various themes, like you said. Pets, fitness seem like a couple that you like, and as well as like the vertical farming. Um, so yeah, let's get into the pets. So yeah, you mentioned a couple companies. You mentioned PetCo, and I see like on Common Stock you can divulge some of your holdings as well. So I see that you also hold Bark for Barkbox, I believe.
Yeah.
Yeah. So
Painful one.
yeah. So let's get into those too. So I mean, I feel like during COVID, a lot of people, not myself, I had a dog prior, but a lot of people kind of went through the whole, sitting at home, being lonely, maybe needing a companion or something like that. So I think there was a big rise in pet adoptions. I'm not sure the exact numbers on it, but I'm fairly certain that there was a lot of adoptions of pets, and I know friends and family that adopted pets as well. So do you think that, I guess, the COVID pandemic kind of helped a lot of these pet companies? And do you think that meteoric rise, so to speak, in pet adoption is going to help these companies in the long term, or do you think it'll kind of slow down once, I guess, things start? I mean, I guess they already are kind of opening up and everything like that, but officially completely open.
Yeah, that's the thing. So, like, yes and no. So, like, yes, I mean, like, my dog is a COVID puppy, right? So it helped, like many other industries. Like pet is not the only one. Many other industries benefited from COVID, like from a pull forward, right? So the years that they would have had in growth, whether it be like 2022 and beyond, in a normal capacity, got pulled forward into 2020 and 2021 just because of the fact that, again, like you said, people were lonely, they needed a dog. I always wanted a dog. I was in the spot to get a dog, so I'm like, great, like I can take care of it, no problem. So that's what actually. So if you look at the Chewy chart from like pre-pandemic to then peak 2020, I mean the stock went up like, what was it, like 200, 300%. I can't remember off the top of my head. It was like incredible. I think it peaked at a price of like $120 a share, and I think it was trading at like maybe 30 something or 40 something pre-pandemic. If you want to call like the trough of March 2020, I mean, there's like a 600% return. It was something ridiculous, right? Um, but that's the thing, though, and this is what screwed over a lot of people in 2020, in the beginning of 2021, because you got so used to this meteoric rise that people are paying up for each dollar in earnings. If they even were making earnings, which Chewy wasn't. Um, but the potential to make earnings was there because they're just growing incredibly fast. So people forgot that, hey, if you're paying up for growth and the growth is not sustainable anymore, the valuation is going to come down. Like no matter how you cut it, it's just going to come down. People aren't going to pay up anymore. So Chewy collapsed in 20. Well, I'm say collapsed, but it basically got cut in half in 2021. From when I shorted it, at least I shorted it at like $85 a share. So it wasn't at the top, but it was up there, right? It was at like 30% off the highs, all time high. So I shorted it. Was like, hey, it's a great company. It's just that it's slowing down. It's not going to be growing as fast as you guys think it is. And at the same time, that's when Petco went public, and people were scrutinizing it as well because they're like, you know what? It's not sustainable. Blah 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 blah. But the main difference was Chewy is an online first company, right? So they're DTC e-commerce, pet food and supplies. Whereas Petco, if anyone is familiar, they have their physical store footprint. Like they're a retail first, then online second. And historically, they've been doing pretty crappy on the online department. But they were having so many initiatives to essentially encompass an overall pet ecosystem so that they could leverage the retail footprint that they already had as not only where you and I can go walk in and purchase goods, but then for the online consumer, they can then use those retail stores as fulfillment centers for the online orders. So they were actually in theory, utilizing what some might label as like a liability, having to pay for all this real estate, when in fact they're just there's two use cases: fulfillment and walk-ins. And on top of that, they're like, you know what, let's go one step further. And then they went further than what Chewy could. They had like, you know what, let's do veterinary services, let's do grooming, let's do boarding and training and all that kind of stuff. So they wanted to be a one-stop shop for a pet owner. Which, if you compare it to Chewy can't do that. He can only send you things. Like, what else is he gonna do? So that's when I came out. I went long PetCo. So like this is a no-brainer. And then I went short Chewy, and I'm like, same space, different kind of business models. And ever since then, I mean, like, again, Chewy's got slammed, and I got out of it. But then also for PetCo, like, so many, not that I'm a fan of what analysts have to say, but it is nice to say, like, when they come out with their own views, like, yeah, like PetCo is like one of the highest conviction stocks that they have because of the transformation that they're going through, right? So to answer your question, like I said, it's like yes, it did help, but then no, because the consequences of what investors paid for the pull forward wasn't able to be held going into 2021 and then 2022. So if you got out the top, great. If you held on to it, I am sorry for you.
Yeah, so I was just looking at the Chewy chart, and yeah, you're right. It got to the top just under 120, and at
Yeah.
the bottom, right before 2020, when March 2020, it was like just above $20, and now it's sitting at $45 and 82 cents. So yeah, definitely a big meteoric rise and a big fall. Although it is higher than it was at March 2020 time, still not that great of a return when it comes down to where its top was.
Yeah,
So,
not even if you go, even in the top 50% of its all-time high, it's still a terrible return if you bought in any of that range.
yeah,
Definitely.
exactly. But yeah, I mean, so the way I kind of view Petco, yeah, they've been doing a lot of these services for quite a long time. It's almost like the Walmart for pets. I don't even know how else to describe it, but yeah, like you're saying, one-stop shop. You can essentially do anything and everything for your pet there. I know when my family personally first got a dog, I want to say that was in maybe 2007 or 8, or maybe even a little bit before that. But we took our dog to Petco for training initially. So, I mean, they've been doing these things a lot for a very long time. It's a very trusted brand. And yeah, like you said, they have the retail footprint. So how do you think that they, can like you mentioned, it seems like they're almost like a retail in-person store first and online second. Do you think that the future of pets services is more so online? And do you think, their retail and their brand name is big enough to, figure out the online stuff second and, keep improving that part of their business?
Yeah. So, I mean, I don't know when the inflection point is between like, oh wait, we're going to be a majority online or not. I think yes, for pet food and supplies and stuff like that, it's definitely going to be an online focus for lots of pet owners. But one thing about pets though, and like you can't forget about it, it's like one thing if you're going to be ordering like shoes from like Nike online, like yeah, I can do that online. I actually never have to go to the store, right? Even if I want to return them, just slap on the return label and I can just send it back. Whereas a pet, like, no, sometimes pets need, not sometimes, like they just do. They do need like health services. They do need veterinary services. They do need to get groomed. They do need to get their nails trimmed. They do need to get their teeth brushed. They need to go in for training. They might need to go in for walks, blah, 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 blah. So like there's one facet that you can hone in on of what can I get online? And there's the other part that's like, what is also necessary that I can't get online, which is the whole reasoning behind their store footprint. Because you have all these other ancillary companies that can provide other dog services, but like it's like, why can't Petco just do that on its own? Like it can, and it will, and it is. So that's kind of why there's just so much runway for them, because if they can create that stickiness with the customer, me, you, then they can squeeze out more dollars per customer, just by doing their own business of each particular aspect. And that's what gets it to the next level, right? Because every single consumer or retail company is just like, how can we make more money? Well, you get them to come back more into the same ecosystem, and that's exactly why, whether it's online or whether it's in person, there's going to be some aspect where a pet owner is going to walk in and be like, yeah, I'll get this. Or if I don't want to walk in, I'll order it and I'll be there in a few days. Done.
All right. So then on the flip side, another one of your holdings is Barkbox, which is strictly online. So how do you think that they, I guess, differentiate themselves from Chewy, and why do you think a Barkbox is going to be successful?
Yeah. So I still am. I'm not gonna say I still am bullish on Barkbox. Unfortunately, it was a SPAC, so I think it really became collateral damage as part of the whole de-SPACing in 2021, which is unfortunate, because the company's killing it. It's actually meeting its targets that it set out when it was going to be a public company and its SPAC. They're again trying to fill out a similar ecosystem, for pet owners, but in a different kind of sense, right? Because they send out like care packages, right? And so I used to get BarkBox for my dog, for toys. I didn't really need the food because she needs to get a special food, and treats. So I got it for toys. So it set it apart from a Chewy or a Petco, whereas like Chewy was different from Petco because Chewy only did food and supplies, and like that was it. Ship it to your door, no problem. But they didn't do it in a way that Barkbox was doing. So Barkbox took it one niche further down and was, hey, we're going to send you curated care packages of toys and treats every single month, for your dog to basically get like a nice little gift in the mail to play with. And I cannot explain to you how happy I was to get those boxes in the mail. Like when she was driving me crazy, I'm like, only 2 more days until this Barkbox comes and she can play with the new toys and like leave me alone. Um, so I'm bullish on it because of the fact that like it's something different that none of them are really doing. I mean, I think like Petco had like Pup Box, but it wasn't anywhere near to the degree that Barkbox was growing. So when it comes to curated care packages, I think pet owners, especially myself, really like benefit from that, because it's a pain to kind of go out and like just buy toys when they've had hundreds and thousands, I think maybe millions of data points about like what dogs liked from the toys that they got and like what kind of like preferences they had. Um, so that I never have to worry about it. I just get it in a box. Here's one, give her like one every week, and then she's good. Which also benefits too is that they also have this other program, which is called the Super Chewer. So what the name alludes to is they're hard toys, right? So it's not going to be like some stuffed animal that your dog's going to get and destroy in like 2.5 seconds. It's going to take longer, right? So for my dog, she's very big on destroying her toys, but with that box and those curated toys that came in there, it took her a little bit longer, which is great for me. So I don't like shell out more money for it. So that's kind of how it was different. And when it comes to me being bullish on it, again, they're building out like dental services or dental products, I'm sorry, for the company. So like they can send you, which I also buy, the like teeth cleaning, like toothbrush, toothpaste, or those little like those sticks. They're almost like greenies, but they're not, to clean your dog's teeth. They're also going to be focusing on dog home. So like dog or human furniture, the equivalent to like dogs. So it's like beds and all that kind of stuff. And then another one was Bark Eats when it comes to prepackaged food for your dog. So like kibble, that you can order, and that'll come in a care package as well on a regular monthly basis or however long you set it, and you feed your dog that way. So they have things in the pipeline to grow it. That all three are between Petco, Barkbox, and Chewy are just different in their own kind of ways. But that's why I was bullish on Petco for the reasons I stated before, and then Barkbox because they're like the person for packages. Like that's their bread and butter is at-home packages.
Yeah, and I think the subscription model of Barkbox too helps a lot, right? So, you kind of keep getting those things, and it's been very popularized in almost every industry. It seems like, whether it's, I guess Netflix kind of started the subscription model, or at least it's the first that can come to my mind. And it seems like in every industry now, there's some large company that's, just bringing in that monthly revenue with however
Yeah.
many people. So, definitely good to have the consistent revenue coming in and monthly.
Yeah, because I mean, like you want to be able to monetize as much as you possibly can, and having a service is a lot more predictable when you're forecasting out your financials. That's fine. You're forecasting your financials instead of like having to like worry about like when's the next sale going to come through. It's like, oh, if I have a couple 100,000 customers ordering on a monthly basis, like that's pretty easy to determine like what my revenue is going to be. It's predictable. If it's something like, one thing that I liked about Barkbox as well is that when it comes to your subscriptions, which I'm sure everybody does, is that the longer you buy, so like, right, like there's some companies that say like, hey, if you buy on a monthly plan, it's this, but if you actually buy the full year up front, you get a discount. They would do that too. So I could buy it on a 1 month, a 3 month, a 6, and like a 12, and I would get a discount on accordingly how long I would buy it. And I'm like, okay, well, I have my dog for the next 10 years. So is there a package for that? Like it's something like that. Like it helps me and it helps them, right? They get the capital up front. And then they can be able to like either like borrow against it, right, as like receivables or whatever, and invest in the core business, or just be able to record it in traditional accounting, right? So that's a benefit to me, benefit to them, and it also looks good in financials.
Yeah, exactly. All right, now let's move on to another industry. You kind of brought it up a little bit earlier, the fitness industry. So just looking at your holdings here, you have Exponential Fitness. So for those that don't know, because I wasn't super familiar with it before, but it's essentially a fitness company, and it has a bunch of various subsidiaries like Club Pilates, Pure Bar, Cycle Bar, Stretch Lab, Row House. So it's a lot of these little, I guess, exercise fitness boutiques that offers a lot of classes and studios. So tell me a little bit why you like this company, and and overall, I guess, why are you bullish on the fitness space? I know you kind of talked about it a little bit earlier about, wanting to get out of your house and everything like that, and I can definitely relate. So yeah, give me your breakdown on the fitness industry and Exponential.
Yeah, so in the beginning of the year, I invested in Exponential Fitness, so the boutique fitness studio, and then also there was F45 Fitness. F45 Fitness is its own like HIIT strength training franchise. It's just one brand. Mark Wahlberg is a part owner in it because he invested in it a couple of years ago. They went public last year, just like Exponential did. I actually knew of Exponential back from my investment banking days because I think they were looking to go public when I was still a banker there, except it just didn't work out for whatever reason. I honestly can't remember. So I was familiar with it, but I invested in both because I'm like, all right, easy play here, right? Post COVID, people want to get out of their house, they want to get back into working out. So like long studios and gyms, short digital fitness, which Peloton obviously was one of the beneficiaries, and then utter disasters of that. So the reason why I wanted to look in the fitness industry is, again, post COVID, but it wasn't like, it's not black and white. It's not you're either doing it in digital or you're either doing it in person. It's quite literally going to be a hybrid model. It kind of was before the pandemic, but the pandemic really put into people's heads like, hey, like I don't actually have to go to the gym to work out, right? Even like my building, we have a gym in my building, and we have access to this one digital company where like I can do yoga, I can do HIIT training just from the TV, right? And that's fine. That works for me sometimes. Other times I need to go lift something heavy. So the reason why I ended up selling F45 Fitness, because I wanted to focus on one. I don't want to have too much exposure to one industry, aside from pets, but different story, was that F45 Fitness is its own brand, its own business, its own franchise. That's it. It's just one thing. So while they were still doing well, the reason why I liked Exponential a little bit more, which made me dive into it more, was that they have officially now they have 10 brands under their parent company. So you can go to get work out in Pilates, working out in yoga, working out in strength training, working out in HIIT, working out in like all these other fitness concepts, but it all rolls up into one parent company. So I could have exposure through diversification of many different fitness models while still only holding the one name. It's not gonna be a one-to-one risk reward. It's like, hey, if one suffers, like I'll have the other 9 to kind of hold me up or pick me up, So it eliminated the risk of fitness concepts being a fad because of the fact that like unless yoga is going somewhere tomorrow, like there's going to be other things that are going to pop up from it, right? Like yoga morphed into hot yoga and goat yoga and all this other weird stuff that I don't understand why, but whatever, people pay for it. So that's one of the main reasons why I like the exponential fitness. It's an asset-light model, meaning they franchise out all of their licenses for their brands. They don't actually own any. I think they actually own it. I take that back. They actually own like a few, I think, because they took it back from franchisees to like kind of like fix them up and then sell them again. But that's not their business model. That's like a one-off thing. So asset light, so not capital intensive. The whole post-COVID return to in-person studios, I felt like we're going to be a beneficiary out of that. One thing that many people, I think, didn't really account properly for was that the pandemic, it shut down a lot of gyms, shut down a lot of chains. So the point where like now when you analyze the supply of the fitness space, it's contracted since COVID because a lot of companies are bankrupt. So now when you think about the transition, if my theory was right, my thesis was right, is that when people are going to go back into person, but there's not enough supply, then the people who are left are going to stand to gain from that, right? Because there's going to be like increased participation in visitation rates. AUVs can potentially keep going back up because they're paying up. They can charge more essentially, right? They don't have to like do steep discounts or cuts, etc. So there was that part. I liked how the company was able to parse out their in-person studios. So like you and me can go do HIIT training one day, but then I can also, if I didn't want to, through the same service, I have to pay a little bit. I have to pay something different, but it's fine. I could do like live on-demand classes at home, or I could just use the digital workouts from their, library. And then they also took it one step further because they knew that the hybrid model was going to be very important. They created this thing called the X Pass, Exponential Pass, which allowed, depending on what you paid for, what tier you paid for, I could take a few classes of HIIT one day and then switch it up and then go to do Pilates another day and then switch it up and then go do yoga another day. I didn't have to just sign up for that one brand. I could go do whatever I want to do amongst all the brands through one like kind of tiered membership, right? So that was something that's really nice. And then the best thing that I love, which I try to tell my other, so when I talk to other PMs, I'm like, just please look at this stock. Like this, I already did the work. Just look at it. Domestically. So when it comes to the CNR space, when you talk about retail, like white space, like what is out there that has not been claimed yet is still really, really big for them. They just came out with their 2021 earnings not too long ago. They have just over 2,000 studios in the US, which might sound like a lot, but it's really not because for their own data, and if you can discount it any way you want, it's still a lot. They believe that just in North America, they can get 8,000 studios in North America alone, right? So if you want to take it at face value, that's 4x left in their growth for just studios in North America, right? That's a credible runway. That's ridiculous, right? And then if you want to discount that, still whatever 3x, that's still huge. Like you're not going to tell me that McDonald's can 3x anymore. It's not going to happen. When it comes to international, basically virtually untouched, right? They just did a recent acquisition that boosted their international store footprint from I think 15 to 150 just from one acquisition. So it's super untouched. So they're planning on rolling out additional studios in Australia. I think it's like New Zealand, Japan, Korea. I forget the other ones. There's so many of them now. Like some in the Middle East, some are in Europe. So the international white space is untouched. So if you alone, that's worth another business in and of itself, right? And one thing that I love about management, and management is owned by this company called was Snapdragon Capital Partners, and they're a fitness PE firm, consumer based PE firm. So like they're operators, right? So they understand that the risk of a fitness concept, right? Like think about CrossFit, like not that it's out of fad, but like this things can come and go at a moment's notice, right? Um, they understand that they need to keep. They don't need to. It's just good business to do M&A transactions of other potentially new and upcoming fitness concepts, roll it up into the overall umbrella. You get the operating leverage of the corporate team, right? So the SG&A could, in theory, grow pretty minimally. But if you're doing more accretive acquisitions and fitness concepts, your total system-wide sales keeps growing. Everything keeps expanding while your corporate SG&A, right, your operating leverage is relatively flat in theory, right? If you're talking about as a percent of sales, or improving just from pure scale. So the operating metrics look great, right? They're actually planning on being net income profitable next year. They're already adjusted EBITDA profitable already. So like it is basically like everything I was looking at, I'm like, this is great, this is great, this is great. And I kept going on. I'm like, how does nobody know about this? I published my research in the very beginning of February, even though I've owned it since before then. And it has done very well since then. I basically ended up buying very close to the dip, and like after today's news of a secondary offering, like the price took a hit just from like a sheer number of shares and hitting the market, not from the company, just from the stakeholders. I'm like, great, I will buy more because I didn't buy enough earlier on. So yes, I'm very bullish on exponential fitness and the fitness space in general.
Yeah, I mean, that's great. A lot of great points there. And it reminds me of there's something here in Tampa where I'm at. It's called the Class Pass. And it's sort of
Yeah,
like X Pass, where
literally.
yeah, except it's all under the same umbrella brand, which, obviously is very nice for an investor and for, anybody like you're saying. And the thing I like about exponential fitness that you're getting into is that it's a class based, and they have, like you said, diversified classes. And I think as far as the fitness industry goes, I think the classes are something that really help people socialize and stay and keep going. Once you go to a few classes, you make some friends, talk after class, and then it's just you get a lot of the same people keep going and get into the habits of that. Whereas maybe like a Planet Fitness or something like that, you get a lot of people where it'll be a little bit more cyclical, in my opinion.
I mean, it's slightly different, right? Because even I don't do cardio. I don't like cardio. I do weightlifting, right? I'm not like big. This is better for my mental health and like what I'm looking to achieve. So even if I went to a gym, I liked going to the gym because like in my own head, I'd be looking at the guy next to me lifting, and I'm like, all right, he's got like 50 pounds on that. Like, could I do 50? Can I do more than 50? Like, how do I work myself up to get to more than what he is? It's almost like an internal competition, right? Um, and you get that socialization sometimes because like you do chat with somebody like, hey man, like I see you deadlifting. Do you mind like helping me out with my form? You may point at blah, blah, blah. There is some level of interaction. Like I say, it's a lot, but it exists. When it comes to these studios, some of them are very like kind of class oriented, right? So they'll be like, hey, like partner up with somebody, or they'll be like, I know like Orange Theory, which is another fitness concept, not owned by Exponential. They basically host on the TVs throughout your class, like who's basically burning the most calories or who's earning the most points, right? Like you like that drive that in person can give you that digital can't really. I mean, that cult Peloton owners will fight me to the death on that one, but it's different, right? It's like same but different.
Yeah, exactly. So you brought it up already, Peloton. So I am very bearish on Peloton as well. So I want you to tell me what your thoughts on it, and I guess why you've kind of, had somewhat of a negative tone towards it.
Well, because at the time, like everybody kept telling me, like, nah, you're wrong. And I'm like, I might be. I honestly might be because the stock just keeps going up, and I can't explain why. So like a lot of my finance friends, I mean, when you're talking about a bike, right? Like if I'm spending $3,000 on a bike, I better be getting my money's worth, right? Like I was paying for the gym. When I was thinking of paying for the gym, like in New York City, again, like I'm very easy. I don't need something intense. Like I had my friends paying for Equinox at $250 a month, where I'm paying for Blink Fitness at $30 a month. Like, yeah, it gets the job done. I don't need to spend so much money. I don't need the bougie Kiehl's lotion in my bathroom. Like, I don't care, dude. But when it came to Peloton, like they were all signing up hand over fist to purchase a Peloton, and they're dropping the $3,000 on it. I thought they couldn't afford it, but because they work in finance, they make money. But it's like they were willing to wait the 6 months before they even got the bike, but they're willing to spend the money. So I'm like, okay, let's think about this. If we're talking about a $3,000 piece of hardware equipment, there's not that many people in the United States that can afford a $3,000 piece of equipment, and B, even if they can, that doesn't necessarily mean they want to, right? But again, like Peloton was like still proving me wrong on that. That people were still buying and buying and buying. But then what I noticed, and this is what really turned, was that if you looked at the resale market for Pelotons, as fast, and from your perspective, as fast as the sales were going up, the resale market was also going up. So the people who kind of had like buyer's remorse after a while were like, I just spent $3,000 on a piece of hardware and I got like use out of it, but now I'm like, I kind of don't want this anymore. It takes up space in my apartment or my home, whatever. The expression came around that it's like, it's better used as a clothes rack than me getting into fitness anymore, right? Because like during the pandemic, everyone's like, yeah, I'm gonna go change my body, I'm gonna eat right, I'm gonna like get bangs and dye my hair, whatever. After a while, they're like, you know what? Like I kind of don't want to work out 4 or 5 times a day on this Peloton. So the resale market started going up, and that's when I became louder. I was like, I don't think there's something wrong here. I don't know if it's right because again, I was wrong as it was going up, but I'm like, there's something there, and eventually, that's when it peaked in February of 2021. It hit a ridiculous number. Was it like $150 a share or something like that? And like it was trading at like $45 billion, but it delivered like $2 billion in sales. I'm like, that doesn't make any sense for a hardware company. I don't care what kind of digital like subscription service multiple you want to give me. There's no way that bridges. That doesn't make any sense. And then eventually, like it started slowing down, right? They're like, oh wait, the supply chain's fixed. Oh wait, now the supply chain, now we actually have too much of a supply chain surplus going on because we were anticipating the same level of growth that fell off a cliff. Like once the vaccines came out and things started opening, I can't even tell you how quickly I ran to the gym with my mask and like my vaccination card. Like, yes, I'm good. Let me in. Like I wanted to go back, and I'm so did a lot of other people, right? So now you're supporting foundation for a long thesis of, people are going to be switching to in-home doesn't hold up anymore because it was a factor of people just couldn't go in person. And that's kind of why they resorted to a Peloton. But then as soon as things started opening up, people shifted, and it shifted very, very quickly. And, like fast forward to February of this year, that's when that presentation got leaked of like the CEO, what was his name, Jim Farley. I always get confused between the Ford CEO and the Peloton CEO, where he's like, we're putting pause on the manufacture of new equipment because we have too much. And I'm like, boom, like guillotine over the neck, like that's it, finished. And like the stock cratered like after that, I think like 20 or 30% just on that move. And then it was funny because once it started dipping so low, I think to the early 20s, that's when the Amazon buyout rumor came out. And I immediately took to Twitter because I'm like, this makes zero sense. Like, and I listed out why. And I have never had a tweet go viral besides that one. That one blew up. And there was everybody from both sides like, you don't know what you're talking about. This makes total sense, blah, blah, blah. If anything, they're getting a deal at this point. And you have other people like, no, this thing is not worth that. And they're not bought out yet. So, I mean, like, hey, so far, it's not a reality. But they were basically like, yeah, like, sorry, hybrid is the new approach. Peloton is not a hybrid. It's an in-home. It's a purely digital in-home connected fitness or not connected fitness player. So like, while there is, while it's still worth something, it's just not going to be worth like the $40 billion that it was a year ago. And that's, you know, how like, if you literally put a chart together between Peloton and Exponential Fitness and F45 and Planet Fit, all the in-person, it was basically an inversion at a point where all the in-person names went up and all the digital names went down. So like, what was it? Beachbody cratered. Oh my God, that was like, someone just got hit with an atom bomb. Peloton got hit. All those guys, like, an inversion happened. And it was really interesting to see because I'm like, finally, like, it broke. Like, I wasn't wrong. I was just early, you know, which depending on who you ask is the same thing. But yeah, but that's my ramble on Peloton. But would I buy one? No. Would I even buy a resale one? No. Would other people do it? Maybe. I don't know. But it's not going to see the growth that it did 2 years ago. Not anytime soon.
Yeah, I mean, I agree with you 100% on there. And I mean, at the end of the day, it's, you know, it's hardware that, whether it's the treadmill or the stationary bike or whatever, it's hardware with an iPad on it when the content on it's limited to what Peloton has. So
Yeah.
the only reason I thought maybe Amazon would make sense is like you could put on Amazon Prime on there and get some, you know, just music or videos or whatever. So when you're riding the bike, you don't necessarily have to do a workout. But I think that's where Peloton, you know, like you said, is limited because the hardware is so expensive, and then you have to pay monthly for it. And then, you know, and obviously when it first came out too, there was such a high demand that they couldn't keep up essentially. And they benefited from the at-home environment in COVID. And now that that's over, just like you're saying, people are more, you know, more desired for that in-person interaction and going to the gym and being in person there too. And I think, you know, as the trend of working remote kind of stays around, which it seems it kind of is, like the gym, at least for me, where I'm at right now is, you know, I'm working from home, so my social aspect of the day is going to the gym and doing one of these classes. So I, for one, am not going to want a Peloton or something like that because I don't want to stay at home and work out. I want to go, you know, interact with people or go somewhere and work out. And I think having that taken away from a lot of people just has made that, you know, more sticky of a footprint now, opposed to before, maybe the pre-COVID days where maybe people were like, oh, you know, I'll work out at home or I don't necessarily have to do it. I think, you know, the lockdown kind of, like you said, accelerated the in-person growth when everything started to open up. So
Yeah, and like one last point to that. Sorry, it's like, because all that is true. Right? I agreed with you. I agree with you. But one thing about what you mentioned as well, it's like, yeah, it's an iPad on a bike. So I'm like, I didn't have any hard numbers on this, so it was pure assumption. For the people that could afford a Peloton bike, I would bet you a good amount of money that the people who could afford a Peloton bike also had a Prime membership. So I'm sitting there, I'm like, okay, thinking if I can invest in banker, why would I be paying for the subscribers that I already have on Prime to pay for them on Peloton? I could just convert them, right? They're already a part of the Prime service. I can keep them on Prime and I can like build my own bike. It's not the first time Amazon's built something on their own, right? And then market it as like an Amazon subsidiary or whatever. So that was my argument because I'm like, you got this company who briefly became profitable during the pandemic and then cratered again, where Amazon could easily, anybody honestly, could easily replicate it without any issues. Or I can invest in like exponential fitness where like they're growing EBITDA margins by like over 1,500 basis points in a year. Like, are you kidding me? Like, what companies can you say like expanding profitable margins by over 1,500 basis points? You can't, right? So it's like, number one, Peloton was a dud. And then two, that buyout rumor, it was very much a rumor, right? It's just Amazon's corporate development team analyzing an opportunity that got leaked that pumped up the stock a little bit for a very brief amount of time because it's already retraced back to what it was before that. And that was it. That's it. It's done. The conversation's over. We moved on. And that's what happened.
yeah, exactly. All right, so now let's get into one last industry. You told me you don't really like the supermarket industry. Tell me why you don't like it, because I feel like, like we've kind of talked about, how different industries during this time have either benefited positively or negatively from the COVID pandemic. And I feel like the supermarket industry is definitely one that has benefited because a lot of more people are maybe, like I said, working from home, having more time to cook at home and things like that. So why aren't you a big fan of the supermarket industry?
So here's the thing. I should have specified. So I don't like supermarkets because there's just no sex appeal to it, right? It's like, okay, I go into the store and I buy my pasta or buy my meats or whatever, and get it and I go. That's why I don't like it. It's very slow growth, right? Um, so it's not going to move the needle as much as my other names could, right? So that's why I don't like it. But on the flip side of this is the most important part, especially now. So if anyone that's listening, pay attention. Is that when it comes to high inflationary environments, or AKA potentially us going into a recession, not saying that we are, but that's a very real possibility. Um, Supermarkets tend to do very well. They tend to be very big outperformers. And I actually wrote a thread on this on my Twitter account on how um, supermarkets, number one, like if I'm looking at consumer discretionary income, if it gets contracted a little bit, the first thing I'm going to cut is my expenses to a Peloton membership. But I'm not going to not spend money on food to keep me and my family alive, or my pet alive. So there's that type of recession-proof-esque type of business uh, um, position for it. However, in an inflationary environment, which I spoke about with a couple of my other Twitter friends in his spaces recently, was that in a high inflationary environment, supermarkets do really well because um, the example that I gave, at least in the Twitter spaces, was that if I'm buying like a package of like $5 Chips Ahoy cookies, right? Everybody loves Chips Ahoy. Hopefully, everybody loves Chips Ahoy cookies, but it's a branded product, and you're paying a premium for that branded product. But now, when you slap on inflation to that, that $5 box of Chips Ahoy might not be $5 anymore. It might be, 6, 7, et cetera. I don't know. I'm spitballing numbers here. So the way that consumers benefit from that is that while they're paying more, while the supermarket themselves are paying more to acquire that branded Chips Ahoy cookie, they themselves, because they know they can get more margin from their own private label stuff, right? So then Walmart will have its own like Walmart chocolate chip cookie, and it'll be like half the price, but they actually get more of a percent margin on their own private label goods than they would on the branded more expensive good, right? Because it's not, the margin isn't a 1-to-1 because they own that product, they own the supply chain of that product. So now on top of that, so if you already ditched your Peloton subscription model, but I need to buy food. Now when I go into Walmart and I'm craving cookies, I might not spend the $7 for Chips Ahoy, but yeah, sure, I'll spend like the $4 or $5 for the Walmart branded cookie, which I know is like not going to be as good, but it's still pretty good. And get that Walmart benefits. Same thing with I don't know the other like unbranded stuff there are, but there's just so many like sugar, flour, like anything that gets branded, you could just buy it a private label from Walmart. They get more of the margin, and they benefit more. Same thing with like I think I mentioned in my thread. I mentioned Kroger being one of them. I mentioned Albertsons being another one. I think in the last year they're both up like 50%. And this is a supermarket. Like literally, it's a supermarket. And they're up 50%. So I think while so many people get so caught up in like tech names and like they're inventing the future and blah 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 blah, I'm like, yeah, well, you know what? Your future's down 70%, and the freaking supermarket chain over here that literally sells cookies and meat and chips and stuff is up 50%. So like, like open up your horizons. But that's kind of my love-hate relationship with supermarkets. So do they serve a purpose? 100%. Can you exploit it in a high inflationary environment? Yeah. And while it doesn't have the sex appeal, it can still, as you can pull up on like on a chart on your own, still deliver pretty stellar returns if you're just patient enough.
Gotcha. All right. Well, that makes sense. So you kind of mentioned the inflationary environment. So we'll wrap it up here with one last question, or I mean, I guess a two-parter. So, how are you viewing this inflationary environment? Are you changing, I guess, any of your strategies when analyzing companies? And what would you give? What advice would you give to any new investors getting into the market now during such an inflationary time?
Yeah. So, am I first thing is, am I changing anything? So since the beginning of the year, I've definitely tried to move. I haven't moved quick enough, unfortunately, but it's fine. Um, into more names that have earnings power. So like they're actually making money because, unfortunately, high growth tech stocks aren't going to pay the bills. When they're not making anything. They might be growing, but when you think about the cost of capital and like when the rates keep rising, you're like, okay, well, simple math says that it's not going to be worth as much. So um, there's that. So that's why I've shifted into names that actually uh, have earnings, have cash flows. Like cash is going to be really important. So they invest it back into the business and have to like do secondary offerings or like uh, was it with unfavorable terms, right? Because if you're doing equity offerings, you're going to do it at a pretty steep discount when rates are rising, right? So stuff like that. I do have exposure to some tech names. So I don't want people to think I don't. They're just more select. So other aspect of that is pricing power. I've spoken to that in the Twitter Spaces as well. So one name that we're invested in is Domino's. They have like a national offering of like mix and match two for $5.99 each. Okay, that's pretty cheap. So if you think about the end consumer, if you raise it by $1, do you think they're going to be like, oh, you know what, I'm out? Like, no, it's $1, right? If you go from, well, in that case, it's $5.99 each to $6.99 each, so you're pumping it up from like 12 to what is that, like 14. That's a lot better than like someone who already charges like $20 for something. He's like, hey, you know what, I got to raise this by like 10 or 20%. Like that's a lot, because like while the percent might be the same, the nominal, like the absolute value of it is different. So it's easier for me to eat a dollar increase on a like $6 good than a $2 increase or even a $1 increase on a $20 good. It's very different. So stuff like that. And the piece of advice that I would give to investors, and I just don't get it. Like no one understands it, and it's like really annoying because I'm like, it's common sense. Is it's very easy to get caught up in a company's story. Like they sell you on their story, and that's why you invest. You have to, and this, it actually pissed me off today. On Twitter and on Common Stock, and not because of the platform. I want to make sure that's the thing. It's not because of the platform. It's literally because of the people who interact on them. Like they're just, I don't know, but they always talk about like the good things about things. Like they're like, yeah, they're doing this right, they're doing that right, they're doing that right. Like okay, so like this is why you're long. I'm like, yeah, like, but what else? They're like, what do you mean? I'm like, what like. Those are very non-quantitative points that you're making, right? Like that's just like yeah, some companies are just doing really well. Okay, why can't they do bad anymore? Like that's definitely one thing that I've always talked about with my other portfolio manager friends. Is like when they used to grill me, like when we did a roundtable, they would grill me on my idea. They'd be like, why, like why not this? Why this? Why not this? So if you can't take whatever thesis you are, whether it's long, short, or whatever, if you can't keep poking holes into it and your idea still holds validity, then there's something wrong. So you have to make sure that you look at it from a very like open eyes perspective, because you might be wrong and just buying into the hype. And just to kind of piggyback off that for like 30 seconds is like, I looked at Figs, which is a healthcare scrubs apparel company. Every single person was like, this is the next Lululemon, but for healthcare. Everybody said that. Everybody only said good things about it. And then so when I started looking into it, I'm like, this might be a pretty good long idea. Let me check it out. So when I did, I went in with, I'm gonna buy it to hold it long. And then I started doing my research. I'm like, wait a second, this is not what it is. There's stuff that's not going to support the valuation. So I flipped. I actually went against it. And I was like, no, I'm shorting this. And I shorted it. And when I published my research, the amount of angry people on Twitter were just like, you have no idea what you're talking about. This is definitely the next Lululemon. They're growing so fast. Like my nurse who has these things like loves them, blah, 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 blah. And I'm like, I didn't say it was a bad product. I just said the company just isn't worth as much as you think it is. And then that was when did I short it? $33 a share. And I think it bottomed at like 13 before going back up to 20. But it's like, it's one of those things where like herd mentality, right? Like you either think what other people are thinking without actually applying any other level of due diligence, or you go about it yourself with such tunnel vision that you're like, it has to be this, and I'm going to find any reason to support my initial thought that I'm not going to care about everything else. And then you see so many people getting burned. And it's like, no, like you have time is on your side. Like take the time. Like if you miss out on a company's move price action by like 10%, but in the long term, it can still generate like 50+%. I'd rather have that than take the risk now and have it drop by 40, 50% because I was like too early. I didn't analyze things properly. That's the advice I would give to people is take your time. And before you put $1 into something, do the work, because I imagine that a lot of investors these days, like they worked hard for their money, right? They're not like, I'm not a trust fund kid or something. Be smart about it. Don't be dumb and take your time.
Yeah, I mean, I think that was one of the first pieces of advice I heard. I don't know if somebody told me this or I heard it on a podcast, but it was essentially just exactly like you're saying. Look at a company, and if you want to invest in it, try to find as many holes as you can. You got to look at it at both sides of the coin and weigh everything. Because if you can't poke holes into an investment or into some company, because no company is perfect or anything like that. They might have a really good moat or great product or whatever, but there's always something that there's going to be some bear out there or something like that. So if you can't poke a hole in it, you're probably missing something, and that's exactly like you're saying, that's where you're going to get burned. So
oh yeah, I mean the multiples thing is hilarious too, because everyone starts like talking multiples, and I'm like, you're talking about the most relative valuation method and in the history of valuation methods. Like, yeah, it should be trading at 10 times. I'm like, okay, well, why not 8? Why not 5? Why not 2? Why not 1? Come on, like let's be real here. You got to pressure test this stuff. So that one always gets me. That's a funny one to kind of poke.
Yeah, for sure. All right, Paul. Well, I appreciate your time. Let everybody know where they can find you and what you got going on. I know you got, you said your Twitter account and you're active on Common Stock. But yeah, sign us off with everything you got going on.
Yeah, so if you want to, you can follow like my personal account on Twitter. It's just at Paul Cerro, PaulCerro. It's the same thing on Common Stock, so you can actually see like other things on there, like whether it's my portfolio or not. If you want to actually subscribe to my newsletter, it's just type in Cedar Grove Capital Substack in Google, and it'll pop up. Again, we only focus on consumer and retail names that have like also a tech component as well. Doesn't need to, but it can, along with the cannabis industry as well. So if you're interested in that space and don't want to have just exposure to traditional like tech, SaaS, growthy companies, I would encourage you to subscribe and see all the other content that comes out besides just single name coverage. So that's how you can find me.
Yeah, for sure. So I will be subscribing to that. And Paul, thank you so much for your time. I really appreciate it. And yeah, I'm Brandon at Green Candle IT on Twitter. You can find my Substack at greencandleinvestments.substack.com. And yeah, Paul, I'll start interacting with you a little bit on Twitter and on Common Stock. Yeah, I really appreciate all your ideas, and you opened up to my eyes a little bit on the fitness and dog or pet industry. So maybe I'll be buying some of those. Here or there. So I really appreciate it. And yeah, that's it for me.
Yep. Thanks a lot, Brandon. I really appreciate you setting this up.
All right. Sounds good. Thanks, Paul.